Hello there. Are you sitting comfortably? Because I'm going to give you the answers to the quiz I set a week or so back. So let's get straight into it. Question 1. 5 types of asset you might use to build a portfolio. At the very highest level, this was a sort of easy introduction to the quiz, I think. Equities, shares, that's the first asset class. Usually the next one to come up, which is its correspondent as it were, is fixed income or bonds. Then you can have real estate, which perhaps we sometimes call commercial property or physical property. And finally, of the main asset classes, I would suggest cash or funds kept on deposit, with an extra asset class to make up 5 of commodities, which for UK investors is usually going to mean buying precious metals like gold or silver rather than agricultural products because of the complexity of the markets in soft commodities. An extra class could be alternatives, which would cover derivatives. There are not many types of derivative investment available to retail investors, in that the UK does not authorise hedge funds for retail investment, or at the moment much by way of private equity. But absolute return funds might fall into that category. We've started to talk about diversification already, because one of the ways of diversifying investment risk, turning to question 2, is by picking different asset classes at the high level. So, for example, having some equities and some fixed income. Another diversification is geographical, but on the other hand, we live in a pretty globalized world, so to get any true degree of diversification, one is probably going to have to distinguish between developed Western markets and other markets. You can get a little bit of a diversification, partly because of politics and interest rates with their feed into currency by dividing money between North American markets and European markets. But more diversity and less correlation is achieved by investing in emerging markets and the Asia Pacific region, more of which later. A third method of diversification is by market capitalization. One can buy mega and large cap stocks. For example, purchasing a technology fund, you're likely to get a lot of those. Or you can buy mid cap, small cap, or even micro cap funds. And the behavior of shares included in those funds as a collective block, it will be different. Another way of diversification would be by investment style. One can buy funds that invest mainly in growth stocks, that's stocks where money's going to be made tomorrow from a successful business that's not necessarily making a profit yet. Or one could invest in value or dividend stocks. Again, more of that later. In fact, we'll come straight away to the question of growth stocks in question 3. This is definitely a growth stock, the reason being that the PE, price earnings ratio, is very high. The implication of a PE of 41 is that the return on capital is no more than about 2.5% at the moment. The fact the dividend's only 0.3 reinforces that. Anybody purchasing this stock is expecting to make money later, possibly because of the technological advantages this company has, which will give it a market lead and high profits in the future, or perhaps because it would be able to establish a monopoly in something unique, for example, supplying a particular drug, as in the case of Novo Nordisk and Ozempic and Wegovy. Company, as described in question 4, UK mid-cap, might be quite an old business, but it's only been listed for 3 years because it was spun off of a bigger UK group, probably the sort of business that American hedge funds are absolutely hunting around for at the moment. PE ratio, price to earnings ratio, of only 11 implies a return on capital of heading towards 10%, and a dividend of 3.8 is above the typical UK market average, which is in the 3 to 3.5 range most of the time. In terms of investment association sectors, it's certainly going to be listed under the UK because it's UK mid 250. Will it be all companies? I think it could be. More likely perhaps to be UK equity income with that high yield. This stock could be in both UK all companies and UK equity income funds. In the UK small cap sector, there are also funds that are mid cap, so You might find it in all companies, equity income, and UK smaller companies. And of course, it might have been picked by some global funds, so you might find it in other sectors. You might even find it in European funds, because some European funds are not ex-UK. Turning to question 5, AUM is assets under management and FUM is funds under management. These are highly significant to businesses that manage investments as a way of making a profit. That's because the vast majority of business models in the Western investment markets pay people managing investments or advising on investments a percentage of the assets they're looking after. So clearly, anybody running an investment business wants to have more assets under management, more funds under management. Now that's very relevant because that feeds through to the employment practices of these businesses and the way they remunerate fund managers. Many fund managers will have targets for their funds which, if exceeded, will earn them quite substantial bonuses. Clearly, if a fund grows a lot, the company that runs that fund gets a lot more fees, and if the growth is a result of the fund manager's excellent performance, the fund manager deserves to be rewarded to get a cut of those profits. However, that does mean that if you read an article in the general news media, say one from Interactive Investor or Sunday Paper or TrustNet, where the article's been constructed by the journalist phoning up a handful of fund managers specialising in the market they're discussing and asking them what they think about it, you're not going to get an unbiased opinion. If you ask a manager of emerging market funds, what does he think about the prospects for emerging markets, he's hardly going to tell you that they're terrible and you should sell, because that will reduce the FUM or the AUM of his fund and of his company, and will not make him popular and may result in him losing out personally. There are a few, of course, fund managers and for that matter investment advisors right down to the IFA level who don't charge fees on the basis of assets under management. I was one of those, because they would like to have independence of thought and still be able to advise their clients and earn money, even if it's the best thing for the clients to have 100% of their money in national savings certificates. But generally, 95% of the time, fund managers will not give an objective opinion about the market sector into which they themselves are investing. Number 6 is a question where probably most people listening to this video will think I have a bias against investment trusts because I spend more time talking about them negatively than positively. I don't have a bias against them. I am agnostic about the use of investment trusts, and indeed I personally have made reasonable money in the past purchasing them at a discount and waiting for the discount to reduce and then selling them again. But that's because I understand how they work. The mass media, particularly the less sophisticated financial journalists, tend to point to investment trusts as having lower costs than OEICs, the old-fashioned unit trust that we more commonly buy, and therefore being more likely to outperform given that they own the same assets. That's a complete misconception. Fails to take account of the fact that investment trusts are listed companies, just like any other listed company subject to British company law. They're listed on the main stock exchanges. Indeed, the MID 250 is usually quoted ex-investment trust because there are so many of them in it. That means they have a board of directors that can decide what to do with the company within the rules of English law, and that includes appointing the investment manager. If the investment trust is being marketed by an investment house, it's quite likely they'll appoint as investment managers the same investment house that launched the trust. It's a way for the investment house to make money. That is not independent. That's where Saba comes in. Saba is an American private equity investment business, largely in the control of one individual, who, using the normal operation of the shares market, bought large stakes in 7 or 8 UK investment trusts, sufficient for him to be able to propose resolutions at general meetings. And his resolutions included winding up the trust, sacking the boards of directors, various other ways of extracting value, because many trusts are listed at a discount. In other words, you buy the shares at a price that is less than the net asset value of what they own as an investing business if the business was wound up and everything was sold. So there's definitely risks to do with outside interference, to do with non-independence of the board of directors, and indeed more. For example, investment trusts can borrow money and gear their investment risk, which is not possible for collective funds. 7. I think most of you probably get this one right. The investment association sector, emerging markets, and Asia Pacific ex-Japan will both cover the large economies of China, India, and other elements of what is still called the BRICS: Brazil, Russia, India, China, South Africa, although the BRICS is now taken to include about 10 other economies. And the BRICS, as is obvious, includes a large chunk of Asia Pacific based economies, including some very large ones. After all, China is the second largest economy in the world. So you're likely to get some overlap, and you need to check carefully for correlation. There are emerging markets funds with little exposure to China, but perhaps they're biased to India. There are Asia Pacific funds with the same sort of criteria, but you need to be aware that you won't get that much non-correlation in those two apparently different investment association sectors. Question 8. Growth equity funds fall in value more than high dividend funds. It's a fact. Like all facts, it's a generalization, but it's a fairly reliable way of looking at the prospects for equity funds in the context of rising interest rates, particularly if rising rates are in a steady pattern as they were 2 or 3 years ago after 2021. The reason for this is the basic, sometimes hard to understand model for valuing equity shares. The value of a share could be related to its dividend yield. If you think you ought to get a return of 4% going up with inflation on your investment in shares, then you can simply value the current dividend by 25, which would give you 4%, wouldn't it? And that's the value of the share. That's one valuation model. But the market generally values shares on the basis of future earnings and, in fact, future cash flows. So the classic textbook definition is that the value of a share is the value of all future cash flows, not just this year's dividend. And that means for growth shares that pay very little dividend, where the expectation is selling out at a much higher price, possibly some long way in the future, a lot of the valuation is some way away. That also means you expect a better return because, after all, if you're going to wait a long time for a valuation and it's dependent on things happening, you'll take more risk. Money in the future is not worth the same as money today. If I said to you, here's £1,000, or as an alternative, I'll give you a promise to give you £1,000 in 10 years' time, you'd say, well, I'll take the 10-year offering if you make it £3,000. You wouldn't take the same money. In other words, you discount the future £3,000 so that you think it's worth about the same as the current £1,000. And your discount is, in that case, based on intuition, or you just made it up, as I did. But in reality, the market discounts the value of future cash flows by the rate of return that could be obtained on the money if you had it now. And that rate of return will depend on interest rates, dividend yields, and has to be discounted further for the fact that money may be worth less in the future because of inflation. So inflation and interest rates are the main drivers of discount factors. The higher the discount factor, the less future money is worth now. So think about it. A growth share is being valued on the basis of a much bigger price expected in the future. If interest rates go up, the discount factor goes up, and that much bigger future price is discounted more because there's more years to wait till you get it. A dividend paying share is a set of cash flows which are going to come between really quickly in 6 months' time and a long way into the future, but on average are available reliably and sooner, so are less subject to increases in interest rates. Question 9, we're talking here about those multi-asset funds where you get a package of passive index tracking funds in an asset mix determined by the manager's objectives. Most subscribers will be familiar with the Vanguard Life Strategy range, which is certainly the market leader. Advantages are it's cheap. The annual fees on funds like that are around 0.2. I think Vanguard 0.22% in the literature, whereas your own portfolio is probably costing you somewhere between 0.7 and 1%, depending on how much money you've got invested. The more money you've got invested, the more diluted the dealing platform charges are, so that does help. So, advantage number one, cost. Advantage number two, no decision making by you on asset allocation. You really just accept what Vanguard thinks a good idea. You understand that they know what they're doing and that their asset allocation will be based probably on global market capitalisation with a bias towards the UK. You don't have to think about currencies. They deal with that. They either hedge the fund or they don't, and you can find that out. So, simplicity. No real need to understand investment concepts in detail at all. Option three, advantage three, the thing automatically self-balances because it has stated objectives, for example, to hold 50% in North American large cap equities. If North American large cap equities do really well, that index will start to become 55% of the total. Perhaps UK small cap equities are doing really badly and their 5% allocation is now only 4%. What will happen is the fund manager will rebalance on a regular basis, possibly as often as once a month, selling profits and reinvesting the money into assets that have done less well. So selling dear, buying cheap, which on the face of it's a good idea, but that neatly brings us straight into the disadvantages. It might well be that you would have wanted to sell profits from your portfolio, say a highly successful technology element, and have the money. Now, if you want money out of a multi-asset fund, you can only sell the one unit you have, and that means you're going to sell assets in every category in proportion to the way they're represented in the fund. So you'll be selling the successful and the unsuccessful funds at the same time. The second disadvantage that immediately occurs to me is the fact that you are exposed to currency risk irrespective of whether you want to take it or not. It may be hedged out, but if it's hedged, there's a cost. If the fund manager allocates 50% to North America, you're exposed to the US dollar. If you were running your own portfolio and had a very negative view about the prospects for the US dollar, something that might emerge out of Trump 2, for example, you might substantially reduce your exposure to that currency and buy one that you think will benefit from a depreciating dollar, or will lose less money, let's put it that way. Because after all, if you had a lot of assets in the dollar and you're in the UK and the dollar falls, your pound value, which is what you're interested in, is going to be less. You can't interfere with that allocation in a multi-asset fund. Another disadvantage is that the asset allocation, subject to a set of rules, may become out of date. The set of rules which might have been appropriate when the fund was first marketed, in the case of Vanguard Life Strategy, by the way, that's probably at least 15 years ago now. Those rules might, for example, have been constructed around the MSCI global all shares asset mix. That might become completely inappropriate. The world changes. For example, if you'd been able to buy such a fund in the 1970s, you'd have had a really fat allocation to Japan, on which you might have made virtually no money for the next 30 years. So rigidity and tendency of the operator, whilst they're making money, to not change anything. You know, if it sells, don't fix it, is a variation of a well-known phrase. Now, there's a lot more to be said about multi-asset funds. They have many advantages, particularly for people who have been used to running their portfolios, like you and me, but think it's going to be difficult in the future because of our age, mental health, and so on, or because we think it's, we're not going to be there to do it and somebody else will have the money. But we'd like to see it staying in markets. The simplicity and low cost and relative reliability and, on average, decent performance of these funds makes them attractive. But to understand this in full, you need to read all the short articles in the Multi-Asset Academy section of this website. That's it. Any questions, please email me, make comments, or talk to me when we next are in touch. Hope that's useful. Bye for now.